I counted the $1,000 on my kitchen table and wondered how long it could protect me. I put the money into my wallet, feeling better simply because it was close to me. I walked toward the bank, already imagining this money becoming a little more secure. I stepped inside the branch, believing I already understood what would happen next. I handed over the cash, expecting it to simply move somewhere safer. A moment later, my account showed exactly what I had deposited, $1,000. I looked at that number and felt like I had solved something important. I walked back outside feeling comfortable because I believed my money was safe. In my head, I pictured the cash sitting quietly inside a bank vault. I imagined my own $1,000 sitting there, separated from everything else. Then the picture disappeared, leaving me with a much simpler question. I checked my banking app, looking for something that could explain where it went. All I could see was a number, $1,000, sitting there without any cash attached. I looked back at the bank, wondering what was happening behind those walls. For the first time, I wondered where the physical cash had actually gone. I thought my $1,000 was simply sitting inside the bank. But what if it wasn't? I wanted to understand what happened after my $1,000 entered the bank, so I started with the explanation everyone seemed to know. The idea sounded simple. A bank receives deposits, keeps a fraction, and lends the rest. In the example, 10% of my $1,000 stayed behind as reserves. That left $900 available to become a loan. Then that $900 could become someone else's deposit in another bank. That second bank would keep another fraction and lend another portion forward. Then another loan appeared, followed by another deposit, and another loan after that. The numbers kept multiplying, making my original $1,000 look much bigger on the screen. At first, I thought I finally understood how banks created more money from one deposit. But then I looked at the diagram again, and one detail started bothering me. Did banks actually calculate every loan by keeping 10% and lending 90%? The simple diagram suddenly felt less like reality and more like a story designed to make banking easy to understand. Then I found something different, a modern bank balance sheet with two sides. I compared the old explanation with the new picture, trying to see where they actually matched. The more I looked, the more incomplete that old explanation started to feel. Except that's not really how modern banking works. I followed a home buyer who wanted a $300,000 house, but didn't have $300,000 sitting in cash. The house cost $300,000, a number that immediately made the gap between wanting it and owning it obvious. The buyer didn't have $300,000 in cash, so the next step was a mortgage application. I watched the application move through the bank, wondering what would happen if the loan was approved. The bank reviewed the borrower's information, weighing the decision before committing to the loan. Then the loan was approved, and the entire story changed in a single moment. A $300,000 deposit appeared in the borrower's account. I stared at the number, trying to understand where that $300,000 had actually come from. I looked for the physical cash, expecting to find some enormous pile of money moving through the bank. But nothing resembling $300,000 was carried into the room. Instead, the bank recorded the loan as an asset on its balance sheet. At the same time, the $300,000 deposit appeared as a liability the bank owed. I finally saw both sides together, a loan asset and a deposit liability appearing at the same time. The buyer used that deposit to purchase the house, turning the new bank entry into a real transaction. That's when I realized the bank had created a new deposit through lending. The borrower got $300,000, and I still had my $1,000. So where did the new money come from? I went back into the bank, but this time I wasn't looking for my money. I was looking for the other side of it. In front of me was something much less mysterious than a vault, a balance sheet. On one side were the things the bank owned, its assets. On the other were the obligations it owed, its liabilities. And suddenly, the $300,000 mortgage made sense. The loan wasn't money the bank had lost. It was an asset it now owned. But the borrower's $300,000 deposit appeared on the other side as a liability. Then I found my own $1,000 on that same balance sheet. That number wasn't the bank's money. It was the bank's promise to me. Then I looked back at the mortgage, and I saw the opposite promise. The borrower owed the bank $300,000. The two sides were connected. One person's deposit was tied to the bank's obligation, while another person's loan was the bank's asset. But then another word appeared beneath the balance sheet: reserves. I expected reserves to be the same thing as the deposits sitting in customer accounts. They weren't. My $1,000 was a deposit claim. Reserves were something different, sitting within the banking system itself. The more I followed the system, the less it looked like money sitting in one place. It looked more like a network of balance sheets, claims, obligations, and movements happening at the same time. But if banks can create deposits through lending, what's stopping them from creating money forever? After seeing the bank create a deposit through lending, I started imagining what would happen if it simply kept approving loans. One loan became 10, 10 became 100, and the numbers started getting ridiculous. The balance sheet kept expanding until it filled my entire view. For a moment, it looked like banks had discovered an endless source of money. Then a risk officer stepped in and stopped the process. The bank couldn't approve everyone just because someone wanted to borrow. The borrower had to be able to repay, because every new loan also created risk. Then I saw capital enter the picture, acting like a cushion against losses. Liquidity mattered too, because the bank still had obligations it had to meet. And lending had to make financial sense, because creating credit without profit couldn't last forever. Regulation added another boundary, limiting how far the bank could push its balance sheet. The endless money fantasy collapsed as every new loan revealed another constraint. I finally saw that creating credit was possible, but never truly unlimited. The bank's balance sheet could grow, but it still had limits it couldn't simply ignore. Imagine every bank in America suddenly decided to lend as much as possible. Would everyone become richer, or would the entire system eventually hit a wall? I entered the bank's operations floor, expecting to finally see what kept everything moving. Payments were moving constantly, even when nobody around me seemed to notice. When one customer paid another bank, something had to settle the difference between them. That's when reserves became visible in a way I hadn't seen before. The bank wasn't just watching deposits, it was constantly managing liquidity. Then I watched customers withdraw cash, something completely ordinary on a normal day. The bank had to be ready for those withdrawals, even though it couldn't know exactly when they'd happen. Then I saw capital differently, not as money waiting to be spent, but as a cushion against losses. A borrower missed a payment, and suddenly the risk wasn't theoretical anymore. The loan was still on the books, but now there was a real chance it wouldn't be repaid. The bank had to absorb the problem instead of pretending every loan would work perfectly. That's when the purpose of capital finally clicked for me. Liquidity was different. It was about being able to meet obligations when they came due. And risk management meant constantly asking what could go wrong before it actually did. The bank no longer looked like a vault to me. It looked like a machine balancing dozens of moving parts. The strange thing wasn't that banks could create credit. It was how many things had to go right for that credit to survive. I watched one customer walk into the bank and ask for their money. The teller handed it over, and nothing about the moment seemed unusual. Then another customer arrived and made the exact same request. Then another, and another, until I started noticing a pattern. The line stretched farther than it had a few minutes earlier. Nobody was running, but the atmosphere inside the bank had changed. People started quietly asking each other what they had heard. Someone checked their phone, then showed another person something on the screen. A few minutes later, more people were walking toward the same bank. The ATM line reached outside, turning a normal withdrawal into something everyone could see. I stood across the street and watched the crowd keep growing. The more people I saw withdrawing, the more urgent everything suddenly felt. Inside, employees began responding to the growing demand for withdrawals. The problem wasn't that everyone had become irrational. The bank simply needed liquidity now. I finally understood why every customer could be acting perfectly rationally at the same time. One person asking for their money is normal. 1,000 people asking at once is something completely different. The bank opened that morning with a line already forming outside the doors. Customers moved quickly toward the counters, each person wanting the same thing. Outside, the ATMs were already crowded with people trying to withdraw their money. I stood near the entrance and watched more people arrive every few minutes. Inside, employees began moving faster, trying to keep up with the sudden demand. Then phones started lighting up as people began sharing whatever they had heard. More customers arrived, and the line kept growing instead of disappearing. I looked down the street and realized the crowd was becoming larger than the bank could comfortably handle. Then I understood something simple. Nobody wanted to be the person who arrived last. One person withdrawing money made the next person more nervous, which made another withdrawal feel even safer. The problem was becoming less about the bank's entire balance sheet and more about how quickly it could meet withdrawals. Behind the scenes, the bank searched for enough liquidity to keep meeting the demand, but every new customer arriving seemed to make confidence disappear a little faster. I watched the system strain as withdrawals, fear, and urgency began feeding into each other. For the first time, I understood that this wasn't simply an accounting problem anymore. The bank wasn't necessarily failing because every borrower had disappeared. It was failing because confidence was disappearing faster than liquidity could respond. I returned to the bank, but now I saw my $1,000 completely differently. Customers tapped their cards, checked balances, and moved through the system without thinking twice. I watched one payment move between accounts, almost invisibly, connecting two people who never met. And suddenly, I remembered the $1,000 that started this entire journey. It wasn't simply cash sitting somewhere. It was a claim I could make on the bank. The bank's promise was that when I needed it, I could access that deposit. Then I watched a borrower make a payment on the loan the bank had created. That payment was another promise being fulfilled, moving through the same system. I started seeing businesses relying on credit to keep ordinary operations moving. Workers received wages that had traveled through the same network of financial promises. Customers then spent those deposits again, sending the same financial claims through the economy. The chain connected everything: deposits, payments, loans, businesses, workers, and customers. Beneath all of it, I finally saw the thing holding the system together: trust. The banking system was an invisible network of promises that most of us simply assume will work. I finally understood what the system was doing: transforming trust into credit that could move through everyday life. The bank doesn't just need money. It needs people to believe the money will be there when they ask for it. I woke up and checked my bank balance before I even got out of bed. The number was still there, $1,000. But now, that number meant something completely different to me. It wasn't a pile of cash waiting somewhere with my name on it. It was a deposit, a claim, and a promise from the bank. And behind that promise was an entire balance sheet I couldn't see. I remembered the mortgage, where a loan had created a new deposit. I remembered the balance sheet, where both sides appeared together. And I remembered the bank run, when confidence disappeared faster than liquidity could respond. Suddenly, I could see invisible promises connecting everyone around me. My deposit was a claim, while the bank's loan was someone else's promise to repay. Those promises depended on payments moving, borrowers paying, and banks managing liquidity. And underneath all of it was confidence that those promises would keep working. The old idea of keeping 10% and lending 90% suddenly felt far too simple. I came looking for a vault full of money. What I found was a system built from deposits, loans, balance sheets, and promises. Banking isn't really about storing money. It's about transforming trust into credit.